Okay, people, this is your economic Armageddon again. So the Federal Reserve has poured cold water on the global economy, and the stock market isn't doing well right now. And if you expected interest rates to fall to near zero levels, you should reconsider. The Fed has officially dropped interest rates by 25 basis points. Yet instead of markets rallying, practically everything is collapsing. Stocks and treasuries are tumbling, while the US dollar has reached its highest level since 2022. Why? Powell recently predicted fewer rate decreases in 2025. And as we've discussed, inflation remains an issue despite the fact that all economic indicators, according to the Fed, appear to be strong. So here's the deal. Rates are currently falling from 5.5% to around 4.25%. Money is becoming cheaper, and as in prior cycles, it is easy to predict that the Fed will continue to slash rates until they reach zero. But keep in mind the following statistics. CPI inflation in November has recovered to 2.7%. Prices are still rising significantly faster than the Fed's 2% objective. However, core inflation, which excludes food and energy, is at 3.3%. So everything else, including shelter and services, is becoming more expensive. Core inflation is the Federal Reserve's favored yardstick. Therefore, rising rates are bad for the cost of living. In other words, rates must stay higher for a longer period. Even if you are not in the United States, increased interest rates influence everything, including the price of gold, wheat, and stock indices, which are all decreasing for a cause. When real interest rates remain high, all risk assets suddenly become less appealing. Following the FOMC meeting, the Federal Reserve revised its future Fed funds predictions, and things aren't looking good, especially for stock investors like you and me. According to September's projections, interest rates would reach 3.4% in 2025. However, based on the most recent statistics, the Fed expects rates to rise to just 3.9% in 2025, a half percentage point increase that is highly substantial. So don't expect enormous 50-point decreases in a single meeting. From where we are presently to 3.9%, there is only room for 1 or 2 25-point cuts. The issue with increasing interest rates in the United States is the country's debt situation. Trump will return to office in 2025, and as we all know, he has many grandiose ambitions. He wants to reduce taxes and bring industry back to the United States. Trump wants things created in America, from semiconductors to automobiles. But he understands that he will be doing so in the face of rising interest rates. The cancellation of power interruptions in 2025 just reinforces this. This figure is the Fed's revised dot plot, and it shows where rates will go in the next years, and the results are surprising. Rates may stabilize around 3.5% in 2026, but by 2027, we may still be much above 3%, implying 3 more years of higher rates for extended periods. This is the climate that investors must comprehend. This is the setting against which Trump will operate. Over the next 4 years, there will be greater deficit spending, and the Treasury will have to borrow at higher interest rates regardless of how it does so. It is vital to remember that the United States is a net importer with a poor balance of payments. In the third quarter of this year, the current account deficit hit a record high. We are now $310 billion farther in the hole, and the ramifications are severe. The United States must perpetually borrow money to fund its deficit. There is no surplus to settle the books, and as long as this trend continues, more government borrowing will be required. So this is the baseline condition. The Fed's decision to maintain interest rates high will further exacerbate the problem. They are sacrificing tomorrow's economy to combat inflation today, and this is the major trade-off we must all recognize. The Peterson Foundation predicts that despite low unemployment, U.S. deficits will continue to rise. From now until 2034, the projected deficit will average 6.3% of U.S. GDP, and this does not include Trump's future spending plans, which, make no mistake, will skyrocket, with the deficit potentially reaching 7 or even 8% of GDP. Trump's global trade war will increase U.S. deficit spending dramatically. Now, what Trump stated makes sense. If you bring back U.S. manufacturing and create goods locally, the trade imbalance would decrease. However, he left out the second part. In order to re-industrialize, Trump will need to borrow a large sum of money, which might take the form of direct dividends, lower taxes, or massive company subsidies. With red cards slowing to a crawl, borrowing rates will remain stubbornly high. The U.S. Treasury is caught in a catch-22, and borrowing on the short end of the curve or longer-dated bonds will be a nightmare. In November, the 3-month T-bill averaged approximately 4.6%, while the 10-year note was also around 4.4%. The Fed's refusal to reduce will put upward pressure on short-term rates, and as Trump borrows billions and trillions, long-term rates will remain high. And if the borrowed money is wasted, it will further exacerbate the already existing inflation problem. While Trump wants monitoring of the Federal Reserve, Powell has repeatedly stated that the Fed would stay independent, so he will reject calls for quick rate reduction. During his statement to the FOMC, he reminded the world of the Fed's dual mandate. Unemployment has increased, but remains low, and the committee aims to achieve maximum employment and inflation at 2% in the long term. The Fed has written the playbook, and we must accept it. Until the entire system crashes and all banks begin to wobble, we will continue to have higher interest rates for a long time. So we need to speak about the consequences and how the markets are essentially in spazzle mode. Whether it's U.S. stocks or global equities, everything is getting clobbered. The S&P had its worst day since the March 2022 crash, losing roughly 3% in a single day, which makes sense. Borrowing prices will remain high for both large and small businesses, and individuals will face more pressure on their mortgages and credit cards, causing expenditure to stagnate or perhaps decline further. The same is true for other economies across the world, only that the consequences are exaggerated. Borrowing rates are now rising for them, particularly for dollar-denominated debt, and the dollar index has almost instantly risen much higher. We're on track to return to the 2022 highs, but when the dollar strengthens, it causes all sorts of issues in the global economy, particularly in emerging economies. So if you're investing in foreign equities, there's a reason they're sliding faster than U.S. stocks. It's all due to the U.S. dollar effect. During the FOMC meeting, Powell forecasted that further reduction would require new inflation momentum, and that if it did not, we would only see 2 minor cuts in 2025. But we need to ask ourselves a serious question. How far can inflation fall from here? The biggest threat to this, unfortunately, is Trump's tariff war on the rest of the globe. And remember one basic fact. The United States buys significantly more than it exports. The United States is taking a risk by imposing tariffs on China, Mexico, and Canada, as these nations may react against the U.S. economy, resulting in increased inflation. And let's start with China. U.S. suppliers continue to rely heavily on Chinese goods, and while direct Chinese imports are declining, something else is increasing. Suppliers to the United States continue to rely on Chinese goods at a rate of about 16%, but the cost will be higher since they are coming from middlemen firms. Even if Trump punishes Beijing with a 60% tax, Chinese items will continue to enter the U.S., although under a different label and at greater rates. And what things would be involved? The majority of them are consumer goods that individuals like you and me use, such as those found at Walmart. And just 5 commodities account for the vast majority of all Chinese imports into the United States. 76% of cell phones, 78% of portable computers, 70% of lithium batteries, and 77% of toys. So Christmas shopping in 2025 is likely to get more costly. And once again, I am not suggesting that these commodities will not reach the United States. They very certainly will. But supply chains will become longer, resulting in higher pricing. But what about Mexico and China, namely Mexico and Canada? Trump intends to impose a 25% baseline tax on them as well. How will this influence inflation? It will have a significant impact, with serious repercussions. $400 billion in machinery and transportation products, $145 billion in mineral fuels, and $85 billion in manufactured goods total over $900 billion in imports from Canada and Mexico. And that's why the Federal Reserve is slowing down interest rate cuts. They've determined that Trump's policies will be more inflationary than deflationary for the next 4 years, and it's a simple calculation. If the U.S. manages to manufacture everything in-house, the cost of production will be so high that inflation will skyrocket. If that does not happen, imports to the United States will cost more due to tariffs. Importers will pass on the additional costs to the consumer, or, as previously stated, third-party suppliers will simply extend the supply chain and take their pound of flesh. In any case, the trade war is very inflationary. And when you put everything together, it's not a good situation for the U.S. Sure, high interest rates can help put a lid on inflation somewhat, but it will come at the expense of the national debt. But the debt crisis isn't in the purview of the Federal Reserve. Powell's mandate has been very clear from day one: keep unemployment as low as possible while bringing inflation down to 2%. In 2021, the net interest cost on the debt was only $350 billion. In just 3 years, this amount has ballooned to over $880 billion. It's a very serious problem that's going to get worse in 2025 and beyond. Even if we are witnessing a market collapse, the greater risk down the road is debt default. We don't know how soon that will occur, but the longer interest rates remain high, the worse the situation will be. But let me know what you think. Will interest rates remain higher for longer, and will Powell need a recession to bring them down to zero? Let me know in the comments. Remain safe, and be sure to hit the like button as we traverse these strange times.